In your 20s, the financial advice you hear most often is usually about stocks. Buy index funds early, start compounding now, don't miss the market. And that advice is good, but it is also incomplete in a way that can quietly cost people years of progress. Because for most people in their 20s, the biggest wealth gap is not created by picking a better stock portfolio. It is created by making better investments in the assets that shape your future earning power, your flexibility, your health, and your judgment. Those things do not show up on a brokerage app, which is part of the problem. They are harder to measure, easier to ignore, and often more valuable than an extra few percentage points in annual returns. That is why two people can earn almost the same salary in their 20s and end up in completely different financial places. By their early 30s, one spends everything trying to look financially sophisticated. The other quietly invests in things that expand options, reduce fragility, and increase income potential. On paper, both may own stock. In reality, only one is building a financial base that can withstand life. The hidden truth is that your 20s are less about maximizing portfolio returns and more about maximizing the quality of the engine that produces future money. Stocks matter. But before stocks become the most important investment, several other investments are usually more important. The first is education, but not in the narrow sense people usually mean. The conventional belief is that education is mostly a one-time decision. Pick a major, get a degree, and the market will reward you. That was never entirely true, and it is even less true now. What matters in your 20s is not simply credential accumulation. It is skill acquisition with economic leverage. A coding bootcamp can matter. So can sales training, financial modeling, writing, design, public speaking, AI literacy, data analysis, or a technical certification tied to a real labor market. The reason is simple. In your 20s, the return on improving your earning power often dwarfs the return on investing a few extra $100 a month. A 5% or 7% market return on a small portfolio is helpful, but a 20% increase in income or a move into a higher value role changes the math permanently. This is the hidden cost most people miss. They treat learning as a consumption expense, when in reality, the right learning is an income asset. A course that helps you make $15,000 more a year is not just an expense. It is one of the highest return investments you can make, because it compounds through every future year you work. The payoff is not abstract. It is salary, negotiating power, career mobility, and resilience. If one industry slows down, the second investment is your health, and this is often dismissed because health sounds obvious. Eat better, sleep more, exercise, everyone knows that. But knowing something and valuing it correctly are not the same thing. In your 20s, health is not just about feeling good now. It is about preserving optionality later. The American Time Use Survey and a wide body of health research show how deeply sleep, exercise, and stress affect attention, productivity, mood, and decision-making. That matters financially because poor health is rarely an isolated problem. It raises the probability of missed opportunities, weak performance, burnout, and expensive downstream issues. A body that can sustain long work weeks, focused learning, and mental clarity is a production asset. Most people underestimate this because health costs are delayed. You do not feel the full price of bad sleep in one night, or the full price of sedentary habits in 1 month, but the accumulation is real. The hidden math is brutal. If health affects even a small percentage of your energy, focus, and consistency, it can influence every other investment you make. Your career, your relationships, and your financial discipline all depend on it. And there is another layer here. Health is one of the few investments that protects future investing capacity. You can always buy stocks later. You cannot fully buy back years of poor habits, chronic stress, or avoidable injury. In that sense, health is not separate from wealth. It is one of the foundations that makes wealth building possible. The third investment is location and environment. People talk about geography like it is lifestyle, but for someone in their 20s, it is often a financial decision with compounding consequences. The city you live in affects who you meet, what you learn, what opportunities you notice, and how quickly your career accelerates. Research on agglomeration effects in labor markets consistently shows that dense, opportunity-rich cities can raise wages and career progression because talent clusters around talent. This does not mean everyone should move to New York, San Francisco, London, or Singapore. It means that where you place yourself can have a larger long-term return than many people realize. A lower-cost city can help you save more, but a higher opportunity city can help you earn more. And the difference depends on your field and stage of life. The mistake is thinking in terms of rent alone instead of total trajectory. A cheap apartment in a low-growth environment can become expensive if it slows your network, your learning, and your income path. Meanwhile, a more expensive city may be rational if it puts you closer to mentors, better jobs, and faster career compounding. This is the hidden trade-off. You are not only buying housing, you are buying exposure to a particular economic ecosystem. The fourth investment is network, but not in the superficial collect business cards sense. Real network value is not about having people to ask for favors. It is about being embedded in circles where information, trust, and opportunity move faster. Many young people underestimate how much of career growth is driven by weak ties, referrals, and reputation. Sociologist Mark Granovetter's work on weak ties showed that many opportunities come not from your closest friends, but from acquaintances and extended connections who sit in different information channels. That insight matters because the job market is not perfectly efficient. Good opportunities are often distributed unevenly and discovered through people before they become public. What most people miss is that network building is not a hustle strategy. It is an investment in information asymmetry. The better your network, the earlier you hear about roles, industries, trends, and business ideas. You also get better feedback. You make fewer expensive mistakes because you can ask people who have already made them. In financial terms, that reduces risk and increases upside. And unlike the shallow version of networking, the best networks are built by being useful, consistent, and specific. They are not built overnight. They compound through repeated interactions, good judgment, and a reputation for reliability. That is why your 20s are the best time to start. The market for trust is slow-moving, but once it recognizes you, the payoff can be enormous. The fifth investment is mental bandwidth. This is one of the least discussed assets because it is hard to see. But if attention is fragmented, every other investment becomes less effective. Your 20s often come with more freedom than later life, but also more distraction than any generation before. Notifications, constant comparison, side projects, social obligations, financial uncertainty, and digital noise all compete for cognition. Behavioral economics has repeatedly shown that scarcity changes decision-making. When people feel time poor, money poor, or overwhelmed, their cognitive performance deteriorates. That means mental clutter is not just uncomfortable. It is expensive. It creates short-term decisions that damage long-term outcomes. Buying impulsively, underinvesting in career development, overreacting to setbacks, or failing to follow through. Investing in mental bandwidth can mean fewer commitments, better routines, therapy if needed, a more disciplined digital environment, or simply protecting uninterrupted time for deep work. This is not self-help language. It is infrastructure. If your attention is constantly leaking, your future returns leak with it. A focused mind is one of the highest yield assets in the economy because almost everything valuable requires sustained concentration. The sixth investment is liquidity and an emergency buffer. This sounds less exciting than growth, but in your 20s, it can be worth more than people think. The common mistake is assuming an emergency fund is just cash sitting idle. In reality, it is insurance against being forced to make bad decisions. Without liquidity, a car repair becomes credit card debt. A job loss becomes panic. A medical bill becomes a long-term setback. A sudden move becomes expensive. Liquidity buys time, and time is often the difference between a temporary problem and a permanent one. This is the hidden function of cash. Not return, but control. Researchers have found that financial stress affects behavior in measurable ways. When people are under acute money pressure, they often make worse choices, not because they are irresponsible, but because scarcity narrows the mind. That means an emergency fund is not passive. It actively protects your decision quality. It lets you stay invested when markets fall, stay patient when life gets messy, and avoid the kind of short-term borrowing that compounds into long-term drag. For someone in their 20s, this matters because the years of highest financial volatility are often also the years of lowest margin for error. A modest cash buffer can be the difference between resilience and fragility. And in finance, fragility is costly. The seventh investment is reputation. This may be the most underestimated asset of all. Reputation is not just about being liked, it is about being believed, trusted, and remembered for the right reasons. In your 20s, people often focus on visible accomplishments, job titles, degrees, social proof. But reputation quietly determines who gets called back, who gets referred, who gets the benefit of the doubt, and who gets access when the competition is close. Unlike a stock, reputation cannot be bought in one transaction. It is built through repeated behavior. You meet deadlines, you communicate clearly, you do what you said you would do, you handle conflict well, you do not overpromise. These are small acts, but they accumulate into a public model of who you are. The hidden reality is that reputation is one of the few investments that changes how other people price your future. A strong reputation lowers friction. It makes opportunities easier to access and mistakes easier to forgive. In a world where trust is scarce, that becomes an economic advantage. And because your 20s are when your pattern of behavior becomes legible to other people, this is the best time to invest in it. If you step back, the pattern is clear. The most important investments in your 20s are not just about getting richer faster. They are about increasing the quality and durability of your future choices. Education improves earning power. Health preserves performance. Location changes opportunity density. Network expands access to information. Mental bandwidth improves execution. Liquidity protects against shocks. Reputation reduces friction and increases trust. This is why the stock market, while important, is only one part of the picture. Stocks grow money. These other investments grow the person making the money. And in your 20s, that distinction matters more than almost anything else because the size of your portfolio is important, but the quality of your income engine, your resilience, and your judgment often matter more. The real mistake young people make is assuming that investing means separating money from life. In practice, the best investments in your 20s are the ones that make your life more productive, more stable, and more open to opportunity. They are less visible than a brokerage statement, but often far more powerful. So the hidden truth is not that stocks are overrated. It is that stocks are usually not the first place where the biggest gains are made. The early years are about building the foundation that makes compounding meaningful. Once that foundation exists, stock investing becomes far more powerful. Without it, even a good portfolio can sit on top of a fragile life.